As we head into the summer, Derek, a lot of folks are wondering what they should do with their portfolios. However, the economic news continues to be really strong. We had a jobs report that we both liked.
Yeah, the jobs report on Friday, we saw a gain of 559,000 jobs in May, much faster than what we saw in April. We only saw a gain of 278,000. So people are understandably optimistic. The unemployment rate fell to its lowest levels since the pandemic at 5.8%. So generally speaking, the labor market continues to recover, but not at the pace that the Fed would like.
Right. And so the Fed is going to continue just to give us free money, and it continues to do that. At some point, it starts to concern me that the money continues to slosh around all around the world, and not just here in the United States, but free money has got to go somewhere.
Well, and I think ironically, the Fed's participation in the Treasury market and the corporate bond market has kept the yield curve fairly flat. And what I think could happen is as the Fed does begin to taper and longer term rates start to rise, that actually will have the curious effect of increasing the incentive for banks to lend, which can further stoke the economy. So I think that's something that investors really need to focus on. Don't think just about tapering. Think about what the long-term implications of that are.
Right. So you think about where the Treasury market has been, in particular the 10-year, just stuck around 1.6, closed a little below that on Friday, but just staying there. I find it interesting that the interest rates are going down despite inflation concerns, shortage concerns, but it has to be that the biggest buyer in the world continues to go out and buy bonds.
Yeah, one of our clients, who I think is one of the sharpest clients we work with, keeps saying, what's right, the stock market or the bond market? And the bond market is suggesting that growth down the road will not be that strong. But again, you have the artificial involvement of the Federal Reserve. So it's normally a keep tell, and I'm not so sure it's giving the right signal currently.
Or they're both right. And what I mean by that is because of earnings have been up and the stock market has been up, there is some valuation to where the equities markets are going. We saw that earnings per share were up a significant percentage, and that did line up with the S&P.
Right. Many people continue to say, the market's up because of multiple expansion. But frankly, in the last 12 months, earnings are up 40% and the S&P is up 39%. So the market essentially is adjusting to higher earnings forecasts. And we continue to believe that next quarter earnings are going to be spectacular, high beat rates, as analysts continue to ratchet up their forecasts.
Right. So you think about, and that's the reason why I say maybe they're both right. And obviously time will tell. But that's the reason why equities markets are up. And the reason the fixed income market is stuck is of all of this free money continues to go out there and the Fed continues to buy bonds. We'll have to see. When we talk about taper, a lot of times, people ask me, what does that really mean? It means they're going to taper their purchases because it's just not lowering interest rates. It's a tool that they have and they've been using called quantitative easing for many, many years.
And curiously, we know about the housing market. We know how strong it's been. There's a shortage of available supply, yet they continue to buy $40 billion a month in mortgage-backed securities, which clearly they do not need to do. The housing market is in fine shape. So there may be a discussion of shifting their emphasis in terms of what they purchase and the magnitude of that. There is that Jackson Hole meeting in August. Many people believe that's when that subject will come up. But in the meantime, we're sort of at a stalemate between, whether this inflationary spiral we've seen recently is a spiral or simply transitory. And that's something we're going to learn a lot about with the upcoming CPI announcement next week.
Before we take a break, you talk about transitory, and at least the Fed talks about transitory. In other words, in moving its way through it. We looked at some spot prices of prices down the road of other commodities, and they too are acting like this is going to pass.
Right. One thing you can see in the futures markets is there's a spot market, in other words, the closest to cash. Then there are futures prices, in other words, prices expected in the future. And what you see is essentially prices currently are high, but as you go out further in time, whether it's lumber prices or copper prices, those prices are lower. They call that a contango, and that's something that you need to pay attention to. And I'm sure the Fed is as well.